So your original expectation from this popular financial coach was $1,176,000, right? And you only ended up with $222,000. Where did that $953,000 go? Puff, it's gone. Okay, it was in your imagination the whole time. The market versus infinite banking. Hi, it's Daniel here from MPG Wealth, and today I want to talk to you about the myth of average rate of return and how market versus IBC may be the wrong question that we're asking. Now, I want to preface this with the fact that both are legitimate strategies, and what I mean is there's nothing inherently wrong or bad about investing in the general stock market, right? Mutual funds, ETFs, stocks, bonds, all those sorts of different portfolios, Roth IRAs, 401ks. There's that, and then there's using your infinite banking concept or your policy. But I do want to unveil some of the myths that are being spread around out there that are just not true. So you just need to know why and how each can come to play in your personal, financial and investment strategy. Okay, so let's get into that a little bit. Here's the myth, and I saw this online recently, and here's a quote from a popular financial coach, right, who said that $100 a month invested from age 25 to 65 is $1,176,000. Historically, the 30-year average return of the S&P 500 has been about 10 to 12%. It's a tried and true get-rich-slow plan, and it works every time. Well, first of all, there's a lot of problems with this. Number one, it's not accurate. And I want to explain the S&P 500 is an index of some of the 500 largest companies in the stock market that follow those 500 companies. So essentially, if you invest in an S&P 500 index, you're able to invest in all 500 of those companies. And so it's pretty much a standard metric that's used out there for the general performance of the stock market. And so this person is claiming that you can look at a 10 to 12% rate of return when you're invested here. And so if you do this for 40 years, you're going to have over $1 million. Okay. Tried and true, works every time. So first problem is that these numbers are based on average rate and not actual rate of return. I want to show you what that means. And so we're going to test it out. Okay. So average rate is very different than what you actually make in the market. So I'm going to show you where I got this. I'm using the S&P 500 Periodic Investment Calculator, which you can find online. You can plug in your own criteria. Starting amount, $100, monthly investment, $100 from 1983 to 2023, so 40 years. And then you can plug in other information about taxes and dividends and those sorts of things. So this is following the S&P 500 with dividends reinvested. Okay, and you can see how in the market, you can have this curve here that goes up and down and up and down and then up, right? And down. And so your average is going to look like a straight line, right? Going from here to there. But in reality, it's going to be made up of hills and valleys that go up and down. So if you buy at the top of a hill and immediately hit a value, your stock portfolio, you could easily lose 30%, right? If you time it perfectly and you buy at the very bottom of a valley, then you could see skyrocketed gains that next year. But the point is that your actual return is different from a straight line average that a lot of these people are trying to point to. So let's go ahead and do this, right? We're going to go to the website and do it live. I'm going to put in $100 with a monthly investment of $100. We're going to start in 1983 to 2023. Okay, I'm going to open up this advanced column here, and we're going to count estimated taxes, and we're going to count estimated management fees. So this count estimated taxes is taxing the the dividends that you reinvest. So when you receive a dividend, it's like getting paid cash, and you put that right back in. So you're going to have a tax on that dividend. So this is going to include that tax, and it's also going to include a 1.5% management fee. So with any sort of index, especially mutual funds, managed portfolios, you're going to pay fees for them to manage them. It could simply be a management fee. It could also include commissions and trades and sales loads and all sorts of different fees that you may not be aware of that you should be aware of, right? So we're going to have this capital gains set to 15%, and we're going to calculate. Okay, so what you can see here, the final value of your portfolio, $482,000, and after capital gains tax, $429,000. I wanted to do that live to show you where I got that information. We're going to pop back over here and take a look here. So, what we see, the real return, including dividends before taxes, was $576K. If you include tax on the dividends, jumps down to $521. If you include a management fee of 1.5%, you're down to $482,000. And after 15% capital gains tax, you're down to $429,000. So in reality, your return looked like 9.46%, not 10 to 12%. Now you may be saying, okay, fine, I can live with 9.46%. Okay. You have to ask your question, what would you have done with that money had you not set it aside in an account at 9.46%? You'll have to ask yourself the question, are you going to time the market correctly? Are you willing to expose your accounts to total loss? Because that is a possibility in the market. But I'm going to be realistic here and say that, yeah, you probably could expect that over a 40-year time period of that 9.46%, right? Net return. But how many of you know what your management fees actually are? Because some fees, when you include everything together, could get up to as high as 4%, right? When you include all the other factors, the expense ratios, mutual fund transaction fees, sales loads, trading fees, right? And so I ran the math on this, and at a 2.25 management fee, which is actually fairly common, right? Just a 2.25, you're looking at $261,000 before taxes and about $222K after a 15% capital gains tax, right? So your original expectation from this popular financial coach was $1,176,000, right? And you only ended up with $222,000. Now, I couldn't even include in my calculations here, I wasn't able to account for the tax on your reinvested dividends. I didn't have a calculator to do that. And so the number is actually probably lower than this, but just from this calculation, I found a net difference of $953,000. So where did that $953,000 go? Puff, it's gone. Okay, it was in your imagination the whole time, in the financial coach's imagination the whole time. In reality, the net internal rate of return is 6.55%. So you have to ask yourself, if you're doing this with a management fee of 2.25%, are you willing to put your money at risk of total loss? Are you willing to put your money in a place where you have loss of access to that money in the capital for a 6.55% gain, right, over time? So, and what is that 6.55% going to do for you 40 years from now? And how much is it going to be affected by inflation, which I didn't account for? So let's see. How did we figure out the fee of 2.25%? I went to a fund fee calculator. I put in my initial investment of $100. I put an annual management fee of 2.25%. And for 40 years with an annual addition of $1,200, so $100 a month. And I put in that original 9.8% calculation that we started with. Okay, so even here we have some wiggle room. And this is what it came up to, right? So you're going to end up with that 261, and then I just plug that into 15% off of that from capital gains, and that's how I came up with that number. Okay. So this $222,000, how did I figure out the net internal rate of return estimate of 6.55%? Well, here we go. If we put $100 in for 40 years, and we're looking for that number of 222 right here, right? And we're putting $100 in at the beginning of each month. Well, I found that if you plug 6.55 into this calculator, you end up with that amount. And it says that that's how I came to that number. And remember, it's a little less than 6.55 because we're unable to account for taxes on reinvested dividends. Now, you may be like, dude, you're getting way into the weeds here. Well, that's what I want to do when I'm trying to figure out the best financial path for me to go forward. Depending on what my financial personality is like. If I don't want to just be completely passive with my money, if I want to get involved and find the most efficient thing to do with my money, right, to benefit myself and my family, I'm going to have to do some math. So let's understand this problem. Where did it come from, right? So we talked about this at the beginning. If you use an average rate of return on an index like the S&P 500, it's a very misleading metric because the years of loss weigh more heavily on a portfolio than years of gain, right? So if I made 20% in one year and lost 30% the next, I'm down a lot, right? I'm way down. So you have to take that into consideration. And simple averages don't. Simple averages just take all the years of ups and downs and average them all together. Okay, so let's do it just a really quick practical example. So you have 2 years of return. The first year you had a 30% gain, right? And you see you started with $100, you made 30%. Now you have $130 in that account, in that portfolio. In the year 2, let's say that the market takes a 10% loss, right? So you take 130 and you take 10% of that away, and so now you're left with $117. So that what that means is that over 2 years, you've made $17 on your $100. Okay, so in the first year, you could say that you had, that 30% gain. Okay. And in the second year, you had your 10% loss. So you could say that over the course of 2 years, you had a net gain of 20%. And so you divide that 20% by those 2 years, and you could say, well, on average, I had a 10% gain on average in 2 years. But when you actually do the math on the figures, you'll see that, well, you actually only made $17 off of your 100 over the course of 2 years. And if you divide that 17 divided by 2 years, you'll only get $8.50, right? And so $8.50 a year is only 8.5%. So you can see how your actual return was 8.5%, but your average rate of return was a whole 1.5% points higher. And that makes a big difference over time, folks. So that's where the problem came from. So how did this financial coach calculate this myth? Well, it's simply, they were able to plug in the figures into a compounding interest calculator. So if my target is $1,176,000, like the financial coach said, right, and I started with $0 in my account, but I committed to put $100 every month over 40 years, what type of percentage rate would I need in order to come up with that $1,176,000? And it turns out that I would need a 12.646% interest rate, right? And that's before tax. And that's without any fees. Okay? So you tell me the magic mutual fund that's going to give me 12.65%, right? And including taxes and including fees. Where's that magic mutual fund that's making me that 15% every single year without ups and downs? Let me tell you, folks, it doesn't exist. Okay, so this is not a proven get-rich-slow trick. Okay, this is a marketing trick is what this is. So I want you to be aware of that. I'm not saying it's a bad strategy. It depends on your personal portfolio, your personal financial style and personality. What I'm telling you is to be aware of what you are doing with your money. So again, you must think about timing the market too. No one can truly know exactly what the market's going to do. You can only hope that you buy in a low year and sell in a high year, right? But over the course of time, things are going to go up and down and up and down. Now let's compare this with the infinite banking concept. Take control of your capital or someone else will. So when you put your capital in the stock market, it's under the control of other people. They get to decide what to do with your money and how to use it. With the infinite banking concept, this is not an investment, right? It's not necessarily an investment tool as much of it is your own bank. So you don't want to compare this to returns that you might see in the market, right? You want to compare this to your bank where you're storing your liquid capital. The cool thing about IBC is it puts the power of banking back into your hands, because money that you're parking in your bank, it grows tax advantaged. If you do this right, all the dividends and interest that you make is completely tax-free, meaning you're not having to pay taxes on the gains that you make, right? Unlike just putting it in a bank account, right? It provides you with death benefit. It comes with several different guarantees. And so you can look at, somewhere in that 3 to 4.5% internal growth rate within your policy, growing tax-free. You've got certainty, safety, and privacy, and it will replace your emergency fund, right? That's just if you're parking your money. Now, if you're using that money like a bank, if you're liquidating that money, putting it in and taking it out, you can get this money within 2 to 3 days and capitalize on opportunities, whether it might be that new business that you want to do. So now, you could do this in the form of a policy loan at a competitive interest rate, which is what primarily we're going to recommend that our clients do. It's primarily what I would want to do, right? Because I can withdraw, and that is an option, but then I'm going to give up some of that death benefit that I had with that money that was sitting in that policy. So I would rather use that as a loan, right, and maintain my uninterrupted with compound interest growth that's occurring in that account. So you can take a policy loan, and it doesn't affect the amount of the money that you have in your cash value that is generating that 3 to 4.5% compounded interest growth. Okay, so then I can take that policy loan and invest in something that I have control over, right? So possibilities. There are infinite possibilities, right? Infinite banking, infinite return on your investment, because there may be real estate that you want to invest in. You may have private lending opportunities that you can take a policy loan out at 4% and lend it, do a hard money lend, do something where you're helping somebody else out that needs access to money, and you're lending that out at 12%, right? And so you're creating an interest rate arbitrage on your own money while it's still growing. It could be starting and purchasing a business. It could be purchasing raw land. It could be starting a logging company. It could be paying off debt at lower interest rates than what you currently have. And the point is that, maybe you feel more safe with just plugging your money away into a 401k or plugging your money away into the market and hoping that in 40 years it has what you expect it to have, right? Maybe you feel comfortable with that, but I don't feel comfortable putting all my eggs in that basket, right? I'm not saying you have to do one or the other. I'm saying you should develop your own strategy based upon your financial personality, right? And so when you have control over something that you have expertise in, you can get a very high return on your investment. And again, it comes back to your personal financial personality. And this is something that someone like myself, working with my team that's been doing this for many years, can help you figure out the best way to cash flow your money, the best way to develop your own personal portfolio to use your money. And if your expertise is in the car wash business, then you can use your money there. If your expertise is in starting chiropractic offices, if your expertise is in online marketing or supplement sales, whatever it may be, folks, if it's real estate, right? Then you can utilize this system, this infinite banking concept, to fuel your endeavors while creating a very certain and sustainable foundation for your own banking system. I hope this is helpful for you. It was certainly enlightening to me when I ran the numbers for myself to see what kind of returns I could truly expect to see in the market. I would encourage you to play around with these calculators yourself and see what you can come up with. And certainly reach out to me if you have questions or want to learn more about this. I hope this was helpful for you, and I hope that you have an awesome rest of your day. Thank you.